Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I am here to bring you some trading levels for the upcoming week of October 30th, 2023. I'll be looking at the ETFs for the S&P and the QQQs. I'll also be looking at two or three popular stock symbols. Before I get going here, the usual disclaimer. Precision Trading Labs, we are neither money managers nor financial advisors. Everything that we present is for informational and educational purposes only. So let's take a look at the symbols here. Here's a chart of the SPY, which of course is the ETF of the S&P 500. And so as of the end of last week, we actually entered what would be considered to be a technical correction. So what do we mean by that? What we mean is that if we look up here at this blue line here, that marks the 52-week high, which occurred in the end of July of 2023. So this was the 52-week high, and if that occurred around 459 on the SPY, and so we're now sitting here as of last week's close, just south of 411. Okay, and so if we take this line right here and we just connect that top there and we connect that to where we are now, we can see that we are now down about 10.5%. And so that's what we mean when we say a technical correction. We're more than 10% down from this local high. So that's a technical correction. Of course, a full-blown, real bad scenario is a bear market, and a bear market would be 20% or more off of the local high. So we're halfway there. Hopefully, that will reverse itself at some point. So meanwhile, that is a technical correction. So that's where we are now. So if we get that out of there. So here's where we closed on Friday at about 410 and change. And so if we look at the charts here, we want to see where might there be some potential trading levels. So of course we can see these are price swings that have occurred since the end of July, where that 52-week high occurred. And so we can see that we've made a series of lower highs and lower lows. Okay, so there was a high, there's a lower high, there's another lower high, okay, and here's a lower low and a lower low and another lower low that we formed here. So this, of course, is an old school technical correction, a technical downtrend, a series of lower highs confirmed by lower lows. Right here, this is an area above here, which we refer to as an area of supply. So what do we mean by that? Right here, there was price kind of went sideways within here. And let me just blow this up just a bit here. So we can see price basically slammed down here from this bearish candle. And then we had these two indecisive green candles that are in here, where they kind of traveled a long way, but at the end of it, they really didn't move a whole lot once the candles had formed. And then right here, there's another very, very bearish candle here. And so this area in here represents a base between these two major down moves here. And this is an area of consolidation here. And this is where buyers and sellers were more or less in agreement within this range. And then obviously there was an exhaustion of buyers here. Buyers were no longer willing to buy here. They only wanted to sell. And so this is how these very bearish candles formed here, is that essentially what happened was these sellers essentially had to run down the price chart until they encountered willing buyers. Okay. And so that's that node right here. So we have it. Okay. So this is an area, again, where there was a brief consolidation in a tight range. Then there was a clear, abrupt exhaustion of buyers in the range, which occurred right here. Okay. And then there was an energetic bearish move as the sellers ran down the price chart to find willing buyers at lower prices. So that's what this zone is. So the expectation is when price returns to this zone, there is still some potential selling pressure in here. And we can think of that as when buyers and sellers were in agreement. We can think of basically buying pressure being demand and selling pressure being supply. And what happened here was where supply and demand were in agreement and were effectively in equilibrium, These bearish candles formed, there was no longer any demand at this region here. Okay, and the only reason that these trades occurred is that then the sellers had to run down until they could find demand, but at lower prices. Okay, and so when price returns here, and there is still some supply up here, we can expect a high percentage of the time that there will be another wave of selling. Okay, and so this, we can think of this as future anticipated selling pressure over here. So one way to look at this is that we're waiting for a move of a pop of about 2.5% here in order for us to then put on some sort of bearish trade up here. Okay, and so the way we could put on a bearish trade up here is, and we have this noted over here, is in an area of supply, we can obviously short the SPY from here, and that would be the most direct, simple way. Okay, but we could also buy a put up here. Okay, and then of course we could buy it at the money, in the money, or out of the money, depending on how we decide to structure that trade. So that would be another way of expressing a bearish trade based on this level. Okay, and then two other simple ways to do that would be to basically do a bear put vertical spread, which essentially would be to buy a put and then sell another put to offset the partial cost of that, and that lowers the premium and also changes the dynamics of that trade. So what one can do would be to buy a put here and then perhaps then sell another put beneath that, and again that would change the dynamics and the premium of the trade. And then lastly, another way to express a trade up here would be to sell premium by doing a bear call vertical spread. And so, of course, what one can do would be to sell a call and then buy another call up above. And the point of that, of course, would be to control and manage risks, so that you're not just selling a naked call. Okay, so those are essentially our four different ways that one could express a bearish trade based on this level. Okay, so that's the supply zone there. There's also another supply zone further up. Obviously, we would have to get out of this swoon to be visiting any of these levels up here. So I don't expect to see that at any time soon. But that's the nearest quality supply level, which is right there. Okay, down below, in terms of what might be where we could anticipate a floor or a potential bounce. Right now, we're actually sitting in here, what I refer to as iffy support. This is not clean demand by any stretch, but this is an area of support where we had a consolidation. Price came back, it dipped in here, popped again, and now we're sitting here for a third time. I'm really not anticipating that this is going to hold at all, and so this is really support in name only. So I'm not anticipating anything. I'm not anticipating this holding. So further down, though, right here in terms of the daily chart, which is what we're looking at here, right here is really the first area of clean demand right here. Okay, notice price popped here, and then notice price, then there was a little reversal here, and then notice then a kind of a massive gap there, and then that started this major price swing up, and you had that pop there. Okay, and so if we look over here, we can also see that that there's an overlap here with this wick and the top of the body here and that wick. And so if we look inside of here, there's actually kind of a 2-hour demand zone here. If we use the 2-hour chart, 120-minute chart, there's essentially some clean demand here. And so this would be an area of where the price has not been back here since. And then this would be an area where we would expect that a floor would get put in, at least for the moment, and then we might actually see a bounce from there. So that's sitting at around 395. Now that's also a key level because, of course, that is below the major psychological round number of 400. Okay, so we would obviously keep an eye on that, and hopefully not see it. Hopefully, even if it drove below the 400 level, which is where that 2-hour level is, this is where the quality daily demand level is, and this is where essentially we think that would be a backstop for this market. Okay, so where is that? That's about 3.5% below where this thing closed on Friday. Okay, so that's about 15 S&P points down from about 410 down to about 395. So that's the area on the SPY. Okay, so if we now turn to the Qs, we're going to see roughly sort of the same structure here. There's an expression some people use where the charts are not identical, but they rhyme. And that's a good way of describing the charts of the Nasdaq. Okay, so here's the QQQs, which of course is the ETF of the Nasdaq Composite. And so here's where we closed on Friday at around 345. And so right here, here's that same, more or less that same 2-hour demand zone that I showed you on the SPY. That's sitting in this candle here. If you broke this out and you turn this into a 2-hour chart, we would clearly see a drop, a consolidation, and then that pop there. Okay, and so that's the 2-hour level, and then this more or less is a clean level of demand on the daily chart for the Qs. Okay, and so if I blow this up here a bit, we can see price from here, popped here. Notice now price consolidates there, and then right here you have that larger bullish candle that pops from there, and then it goes right from there. And then obviously then, we got that pop there, and then that essentially that swing that got created there. So that's what we're looking at on the Qs. So in terms of distance, this is a little further down than we looked at on the SPY. On the SPY, we saw that was about 3.5% down. This is a little over 5% down. So this level is a little further down. So in terms of a market bounce, if price kind of drives through and starts heading down again, I would estimate that we probably have another 3 to 5% that you might see the market pull back on here, because of the fact that really the nearest clean daily demand zones are anywhere from 3 to 5% down on the broad market indexes. So that's kind of what we're looking at on the Qs. So here's where we are at 345. Okay, that's about 18 points down on the Qs, and so that would take us down to about 327. And again, that's all based on this structure right there. Okay, so that's that zone right there. So that's where those are the trading levels that we're looking at on the Qs. And again, what one could do, of course, would be to express a bearish trade based on that level of supply, where essentially we had the exhaustion of buyers that occurred right here. And then, of course, down here, this is an area of demand, and this is what featured an exhaustion of sellers that essentially left this level. Okay, so that's the deal with the Qs. If we take a look at the bonds, this is the TLT, which is the ETF of the longer duration bonds, 20 years and greater in terms of duration. That's what the TLT captures. Obviously, it's been, the bonds that have been miserable in terms of price. Obviously, with the FOMC, ratcheting up interest rates. We're now sitting at multi-year lows. This is the 52-week low for the TLT, but these are also multi-year lows in terms of the price. So I would not be looking to be a hero and try to catch a bottom or to be buying at this point. But in terms of where we might see if price would actually then, if we did get a little rebound, right here we have what we refer to as a rally base and a drop here, which is right there. Notice that in fact, this is really actually a base and a drop here. And right here, notice then price drops from here, and then we're waiting for essentially price to return to this level. Okay, and at that point, we would expect that we might actually see another push down. Okay, so at this point, we would just kind of be sitting back and waiting to see what happens here. I would not be racing to really do anything until we got to that level. Okay, so that's about 3% above where we are now. Okay, and again, I would not be looking to buy at any point here, because there was just nothing to push against, and there's no levels here. So the only thing I would be looking for on the bonds, again, if we got to return to this level, I would consider expressing a bearish trade on the TLT from here. Okay, and that's about 3% up from here. So that's what I'm looking at on the TLT. If we take a look at a couple of popular symbols here, excuse me, my chart seems to have shifted on me here. So here's a chart of Apple. And so here's where we closed on Friday. And so right here, we closed here at 168 and change. Right over here, we have a rally, a base, and a drop here. Okay. And so overhead, this is an area of supply, again, where we might consider expressing a bearish trade with Apple. And so that's about 2% above where we are now. And in terms of buying, and let me get these swing lines off here just to make a little more room here. So right here, if we look down, again, about 2% down, this is an area of demand below here. And so if I pull back and we go back to this region at the end of April of this year, we could see price dropped, consolidated, went sideways, and then notice we had a gap and then that very, very bullish candle that popped here. Okay, so this was an area of demand that created here. And we can see when price returned here, we got an immediate pop. Price dug into there just very briefly, and then we ended up with a very bullish move out of there. And then there was that gap that popped from there. Okay, so when price returns back here, we could expect to see another move similar, not necessarily similar to this, but we might be looking for another bounce out of here. And part of that is that the price did spend a whole lot of time here. Now, the one caveat here is that now that I'm looking at this is an earnings gap. So in fact, I would actually be a little more cautious about looking at this level now that I'm looking at this here. This was actually an earnings gap, and we can see that cross there that marks that was. So this was on the heels of an earnings announcement. So in fact, I wouldn't necessarily be looking for a bounce out of here, because this is actually, really a purely news-driven, event-driven level here now that I'm looking at this. So, we would keep an eye on this, but I think the more solid level at that point is probably the one that's right here. So that's about $1 below the bottom of this level. So in fact, the entry to this level is about 2%, but if we look at the one that's right below, okay, that's about 4%. So that's about another 1.5% down from there. So that takes us down to about 161. So I think a speculative level here is that one around 164.5. But then right here, this one around 161.5. That's probably the more solid level, because of the fact that this kind of came about more or less from natural trading, okay, where essentially this one, where we ended up with the pop here. So we'll see what happens here. So we're going to keep an eye on this, okay? But anyway, these are the two key levels that I'm looking at on Apple here. And then again, above here, in terms of expressing a bearish trade, this is about 2% up. And we have again, this is an area where there was an exhaustion of buyers that created. So when price returns here, we're looking for a push down from this level. Okay, so here is Facebook or Meta. I still haven't gotten used to calling it that. Over here, these levels are obviously further apart. So right here, they had just announced earnings a day or two ago. So we had that gap down here. And so there was a gap down. So now we're looking at this level over here. There's a supply zone overhead at around 313 or so. So that's about 16 points, of course, above where we are now. So that's a fairly long way up. That's 5% and change. And then below here, there was a level of demand right here. And we can see price has actually been back here twice, kind of wicked in there and popped from there. So, each time price returns there, we're a little less little less enthusiastic about it, because each time it kind of starts to chew up some of the demand. But we'll keep an eye on this. So this is a level of demand that's sitting here. It has been tested twice. So I'm not a little less enthusiastic about that now. And that's about 7% down. And the last thing we'll take a look at is Tesla. So this was actually a level that we had created last week, and so we can see price actually drove into here. I guess this was on Monday, and so we got a quick trade out of this. We had actually bought a call, and this was we were in and out of this in about a day or so, a couple of days. So this is obviously. We got that pop there. So now this is where we close now at 207 and change. So, could it bounce again from this level? Possibly, but I think with the market sentiment, I wouldn't be looking for another bounce from this level. So, however, this right here is a quality level here. And so this one though is a ways down. That's 9% down. So that's a fairly long way. So we're going to kind of keep our eye on this. I don't see any trade in the immediate future unless there happens to be another thump down in the market this week. But this is the area on Tesla where we could keep an eye on this level that already got tested once. We might get another bounce out of it, so we would probably be looking for price to drill into here a bit, and then we would get it if price then reversed out of here. But I wouldn't just take a blind trade at the front line here. So at that point, then we would do what we refer to as a confirmation entry at the front door of this level, and actually wait for a clear sign of a reversal. On the other hand, if price drove through here, this is a level that we would be confident to take a bullish trade right at the front line as it got there. So this is the demand zone right here, and then in terms of supply. This is an area right here, up here at supply. And that's really the first clean area of supply that we see there. Now, that's a long way up. That's at 250. So that's obviously, we're not going to be seeing that probably at any time in the near future. So I didn't really mark that out. But you can see that's a little less than 50 points above 200 there. So that's like a 25% move to get from here to there. So I'm not expecting to see that at any point in the near future. But that's the area of supply on the Tesla chart. So, but right here, that's kind of a real quality level down here. And then this is a little more speculative level right here. So at any rate, that's what I got. So before we leave here, if you would like to hear a little bit more about supply and demand and how this can be utilized to create high probability controlled risk setups, I'd be delighted to set up a quick call with you and to tell you a little bit more about it, and also show you how we can utilize these zones in order to for better options trades in terms of better entries, as well as creating price targets in terms of setting up trades. So at any rate, that's what I got. Thank you for the privilege of your time, and I will see you guys next time. Take care. Bye-bye.